GCC Banks. We discussed the big picture of GCC Banks. Now let us look at the outcomes of 2020 and how the NPL and provisioning scenes in the overall GCC. We'll look at the country-wise provision coverage, stage 1, stage 2 and stage 3. We'll also look at highlight on the average cost to income ratio country-wise, and we should definitely understand the outlook for 2021. 2020, stability rather than growth due to COVID-19. To a large extent, 2022 also will emphasize the same thing. Increasing regulatory regime in recent years, which got enhanced due to COVID-19, will continue in the future. Customer focus through innovation, focus on branchless banking, cashless and cardless transactions, and online services. A limited credit growth focus on higher customer base and government agencies. Cost and operational efficiencies remains a priority. Robotic, streamlined processes and fintech for this purpose. Profitability took a plunge due to higher provisioning around the world, and the Gulf is not an exception. Limited credit growth focus. Banks like Doha Bank, in fact, we decided to contract the balance sheet last year, but we are growing now. Cost and operational efficiencies remain a priority. Robotic, streamline, customer focus through innovation, and increasing regulatory regime in recent years, which got enhanced. Profitability took a plunge, and stability is the main focus, not the growth. Now, banks cautious to increase the capital. They're conserving the resources in terms of dividend payout. COVID-19 has given impetus to industry consolidation as well. New business model leveraging on technology and partnering with fintech firms. Collaboration, end of the day, that's happening. Now let's look at NPL and provisioning scene in overall Gulf. Overall NPL at 3.4%, reflecting uncertainty and stress on certain sectors of the economy. Net impairment and charges on loans and advances have increased significantly year on year, an average of 59.2%, particularly 23 times increase in stage 1 ECL, indicating the credit quality challenges expected. The average provision coverage ratio for stage 3 was at 60%, while the coverage ratio for stage 1 and stage 2 increased slightly, indicating caution adopted by banks in the, it's very important. Average provision coverage for stage 3 was 60%, while stage 1 and stage 2 indicating increasing provisioning. Now, if you look at a net impairment year on year with an average of 52%, increased significantly. So, stage 1 coverage ratio 0.6, stage 2 coverage ratio 10% out of the total exposure to ECL. Out of the total exposure subject to ECL, 88% in stage 1, 7.8% in stage 2, 3.4% in stage 3. Now, when it comes to country-wise provision coverage, Bahrain stage 1 coverage 0.7, stage 2 coverage 9.5%, stage 3 coverage 57.5%. Kuwait, as per the central bank guidelines, Bahrain 0.7%, stage 2 9.5%, and stage 3 57.5%. Qatar stage 1 coverage 0.4%, stage 2 6.3%, stage 3 88%. Kuwait, as per the central bank guidelines, Oman 58% coverage for stage 3, stage 2 5.4%, stage 1 0.4%. Saudi Arabia 57.8%, stage 1 0.7%, stage 2 11.4%. UAE 53%, third stage 3, stage 2 14.4%, and stage 1 0.6%. So if you look at maximum coverage in stage 3 is done by Qatar, that's a good sign. So the rest of the banks are between 50 to 60% stage 3 coverage. We are 89%. Average cost of income ratio, if you look at Qatar, 24.3%, Bahrain 53%, Kuwait 41%, Oman 56%, UAE 38%, overall 41.4%. So Qatar is the only place where cost income ratio is 24%. Now, if you look at where all the cost has come down, Qatar has come down by 2.4%. Oman has come down by 6.4%. Kuwait has come down 1.6%. Now, where all it has gone up, UAE has gone up by 1.5%. Bahrain has gone up by 0.6%. And overall, if you look at it, it's 1% up, cost income ratio. Outlook 2021 is equally important. Cost and operational efficiency are priority. Use of robotics, analytics, and fintech. Robotics needs to be used, analytics and fintech. NPLs are rising and loan impairment, managing NPL through possible sales and write-off. Banking on NC is ESG. ESG more prominent in 2021. Banking on ESG. So very important is social risk management. So environment plays very important. That's the social governance, we have to look at it. Regulatory focus on Basel IV regulations. Basel IV regulation is coming up. IBOR reforms, AML, financial crimes, EKYC, cyber security, open banking and digital currencies. So it's all a risk integration. Basel IV regulation, finance and risk plays a big role. IBOR reforms, AML, financial crimes and EKYC, cyber security, open banking and digital currencies. Now, managing NPL through possible sales and write-off. There are institutions who have sold the NPL. Cost and operational efficiency as a priority. Cautious optimism, muted growth and greater caution. Very important. Growth is muted and greater caution is required. Further consolidation, industry consolidation, agile working is a norm. So we're talking about social risk management, risk integrations, NPL management. 5R, what we said, is quite relevant at this point. Agile working is a norm. And when it comes to 2021, profitability impact, decline in moderate due to lower loan growth, shrinking profit margins and rising loan provisioning, accelerated digital investments. Profitability impact, decline moderate due to lower loan growth, shrinking profit margins and rising loan provisioning, accelerated digital investments. So profit impact is definitely there, going down. Digital investment is going up. We cannot deny it. So it's all important. Agile working is a norm. Talent and reduce your cost at the same time. All these are major changes in the Gulf. These are key issues. Outlook is important. Areas, if you look at the dimensions of these areas, and again, when it comes to cost income ratios, Qatar is doing well. Provision coverage, Qatar coverage on stage 3 is exemplary, 88.88, while the rest of the Gulf is around 55 to 60%. NPL provisioning, again, every country has shown the way. Now, when it comes to the overall outcome of 2020, nobody is increasing the capital, new business model, stability then growth, limited credit expansion, customer focus on innovation, remedial management, profitability is coming down, cost and operational efficiencies remain a priority. So that's how it is interpreted for the Gulf banks. This is in addition to earlier detailed profit breakdowns we have already given to you all.